How you doing, guys? It's Damien here. My Lyft position in the Revolut trading portfolio is up almost 10% during just a month. Now I bought Uber stock as the second company in this portfolio. 1 month ago I told you about IPOs and why it is not necessarily a good idea to buy at the IPOs. As the example of companies which lost significantly from their IPO price were Facebook, Uber and Lyft. I did not decide to buy shares of Lyft and Uber during their IPOs. Ride-sharing is, however, something which I like, as I believe I was born to be driven. I do not employ my driver yet, but I can use Uber and Lyft for this purpose. Watch the full video to hear my analysis of Uber company. Smash that like button for the YouTube algorithm. It will help reach more people and will encourage me to give you more useful content. A quick comment about my Lyft position. I bought Lyft shares a month ago to my Revolut portfolio. Shares appreciated almost 10% since the moment of buying. I decided to buy Lyft shares because of the very negative sentiment towards ride-sharing companies at that time. I considered Lyft to be much closer to achieve profitability because of its focus on only two markets, the United States and Canada. Lyft and Uber created a duopoly in these markets. Uber's share of the US rideshare market is around 70%. Lyft captures circa 30%. Lyft market cap is currently below $13 billion. It has over $3 billion in cash, $1 billion in investments and zero debt. Lyft is also growing much faster than Uber, with revenue growth for third quarter 2019 of plus 63%. From the last quarterly report, we can see that the adjusted EBITDA margin narrowed from minus 45% to minus 13%, helped by a significant cut in sales and marketing expenses. It indicates that Lyft is taking significant steps toward profitability. Uber is the biggest ride-sharing company, which is present in 65 countries and over 700 cities worldwide. Uber has diversified into long-haul trucking, food delivery, developing self-driving cars and offering banking services to its drivers. Uber made its market debut at $45 per share in May. The shares are down by 40% from its IPO price. Uber shares fell to a record low as stock lockup expired on Wednesday. It means that shares held by early investors became available for sale following a 6-month restriction since the ride-sharing company's initial public offering. It is much safer to invest in Uber shares now, as there should be no more extra supply of stocks to come to the market. I have been skeptical on Uber before the IPO, but I think that the time has come to see the company in a more positive light. We can see improving fundamentals and rationalization of competition. The current valuation is driven by the increasingly negative sentiment, both in the market and in the press. Let's look at the quarterly results. Sales are up 33% year over year. Monthly active platform consumers grew 26% to 103 million. Gross bookings jumped 29% to $16.5 billion, and Uber now has 103 million monthly active platform customers. The core business itself is looking reasonably well, with adjusted EBITDA margins of 21%, meaning that if investments in other areas were stopped, the company could achieve real profitability. Uber has plenty of cash with $12.5 billion in the bank. It gives the company the confidence to continue investments for years. Uber improved segment reporting. It breaks out key individual segments such as rides and eats, as well as freight from other bets. The revenues for Uber Eats, the food delivery option, was 64% year over year. Similarly, Uber Freight showed high double-digit percentage growth at 78%. Okay, the competition. Uber is the first or second biggest player in many markets. In the United States, Uber captures around 70% of the ride-sharing market. Both Lyft and rival Uber have indicated on an easing of the price war. That is a good signal. Both companies want to capitalize on the already captured market share. In every market, Uber faces competition from local players from Ola in India and the UK to Bolt in many European countries. Uber has already made billions from its exits in China, Russia and Southwest East Asia. In each case, Uber decided to leave the market, but it took a stake in its rival business in exchange for the assets it had remaining. In that way, Uber will profit from its partners' success there. Also, competitive rationalization in the food delivery markets could prove to be very positive for Uber. During the presentation for investors, after earnings were published, there was a comment around the discipline around Eats, which suggested that Uber will exit businesses if they cannot get to first or second position within a 12 to 18 month time frame. Uber has ambitions to take a piece of the pie of the food delivery and freight shipping markets. In the food delivery business, Uber meets fierce competition, including DoorDash, Postmates, and Grubhub. Grubhub is still the US market leader. In 2016, Grubhub controlled over half the market. Its market share dropped to less than 30%, while Eats grew from 3% to 24%. The concerning fact is that now Uber Eats is losing share to DoorDash in the US. There are, however, symptoms of a market rationalization in this saturated market. Uber, however, has a strategic advantage in this space. By marrying the rideshare with the delivery business, they create more loyalty from their drivers. Also, having the food delivery included in the rideshare app, it creates more loyalty with the users. It makes excellent sense long term. Uber can create more efficiencies like delivering food and taking a ride at the same time. The way to create a gross margin could be to eliminate the highest cost of a rideshare, which is paying the driver. Uber is working on autonomic vehicles. The company has already deployed $1 billion in this venture, but is lagging behind nearly every competitor in the field. Analysis from Navigant shows Uber is behind leaders such as Waymo or General Motors Cruise in the self-driving space. The main competition for the autonomic vehicles ride-sharing is Lyft, Waymo and Tesla. To get to profitability, ride-hailing companies will have to get rid of drivers or raise prices. The second has been already happening. There is a lot to gain by the ride-sharing companies. Owning and driving our cars is extremely costly and inefficient. The average car is used only 5% of the time and is parked the remainder of the time. Ride-sharing companies can use cars more efficiently. On the one hand, customers are brand agnostic when it comes to ride-hailing. They will take the cheapest and more convenient option. But on the other hand, no one likes juggling between apps. It is advantageous if you can use the same app in whatever country you visit. My theory is that the company's decline in the share price of Uber was linked to the expiration of its lockup period on Wednesday. I feel now much more comfortable to take a position in Uber stock. If you enjoyed this video, make sure to subscribe or feel free to add me on Instagram, Stocks and Freedom. Thank you so much for watching, and until next time, happy investing!